Again, today we're going to go over chapter 9, which is about finance. We're going to be covering quite a few topics in the next few minutes. So, financial capital, what is that? Basically, it's a way for organizations to pay for their equipment, whether it be land, whether it be cars, whether it be machinery. And that financial capital is how they're going to do that. Now, the idea about finance is a way of how to manage the process of paying bills, inventories, equipment, how the business is going to be ran in terms of monetary value, or even if they take on debt, which we'll talk about here in a little bit. So there's something called shareholder value. And so companies will invest in organizations for a return on their investment. It could be retirement plans. It could be 549s, which is 529s, I'm sorry, 529s, which is retirement plans used for education, not retirement plans, but they're plans used for education. And so we've talked about social responsibility way back in chapter 4. We've talked about shareholder value in other chapters, but we can tie this together now because a, a responsible organization will be truthful with their shareholders. They're not going to withhold anything. And now with the issues that occurred in the early 2000s about organizations lying on their balance sheets, we haven't seen as much deception of shareholders because the CEO will go to jail if they deceive their shareholders. And so um, you're not, like I said, you're not seeing this much anymore, which is a good thing. We can invest confidently in organizations knowing that what they're saying is what's happening. So there's risk. Um, Risk is this idea that we can measure. So there's risk and uncertainty, and you see uncertainty in a line there. But risk and uncertainty are two different things. So, for example, risk we could put a quantitative value to. So, for example, you walk on ice at night. There's statistics that show that you have a 50% chance of slipping and falling on ice. The uncertainty is we don't know where. So again, risk we can quantify, uncertainty we don't know, but we know something could happen. Okay, so asset management ratios. This is one of the things we have to, first of many ratios we're going to take a look at. And this idea of how the firm or company is managing their cash in comparison to what they're buying in terms of their assets. All right, so the cash itself is, it could be $2, could be $100, could be $1 million. But are the assets that they're buying generating more cash? In other words, okay. So that's what's happening here. Now, there's financial leverage. What financial leverage is all about is where the organization is taking on debt in order to buy new equipment or in order to get a new building. So they can do this by issuing stock. They can do this by issuing bonds, and so they will use debt. But at the same time, the shareholders and the bondholders are going to say, "Hey, we need some money. We need a return on this. Otherwise, they can pull their money out, and that will really harm the company." So the company has to be careful here, not to leverage themselves too much in terms of debt, because they may not be able to get out of it. Getting getting happy here with my mouse. All right. Profitability ratio is how much rate of return they're getting. So how much money are they making in terms of, is it 10%, is it 12%? And this is important because as investors, we want to take a look at a return on investment. So maybe we need a 10% return or projected 8% return, and a company comes back with 6% return. Then we have the decision, do we want to stay with this company or not? Also, in regards to an investment in property and equipment. So our organizations making money, a set amount of money on what they're buying. So return investment capital could be, for example, we buy a piece of machinery. We think that we're going to get 5% return on investment based upon this machine. Perfect. And so if you can say that, if you can prove it, you're good. But again, as we talked about earlier in this chapter, CEOs have to be honest with their stockholders and shareholders. Otherwise, they're going to be running into a lot of issues. All right, so the income statement. If you are looking for a company to invest in, if you're looking for a company to work at, look at the income statements. Now, this is available in a publicly traded company, so those that issue stock. A private company do not have to do this. I'm sure they do it, but they don't have to disclose it. All right, so just be careful of that. But if you're looking to work at a publicly traded company, take a look at the annual reports. The annual reports have to have an income statement to show how healthy the organization is. Now, if you see on the income statement that they have a lot of cash on hand, great. That is the lifeblood of an organization, the cash. If they have a lot of receipts coming in, okay. Because just because they have receipts coming in doesn't necessarily mean that they're going to get the money. Okay, so be careful with that. If they have a lot of debt, if they have more debt than they have more cash coming in, that's a red flag. They might be in trouble. So you can get all this on an income statement. Cash budget, again, look at how much cash the organization has. All right. And it has to be on hand. And if you look at the future cash flows, this is again what we talked about in the last slide, the projection of receipts that we're getting in from customers for work that we completed. This doesn't always necessarily hold true. For example, I worked at an organization, it was a printing organization, and we did this catalog. It was $250,000. So you know that $250,000 receipts was going into, cash budget coming in. Well, what happened is that the organization that we did the catalog for, they went out of business. We never saw a dime of it. So we lost money on that job. So, like I said, you have to be careful about what is projected to come in. So we got some short-term financing. Um, in regards to trade credit, um, you look at this financing where I buy a product and I get it and I'm saying, okay, I am going to pay you in increments. And we do this a lot, and we have these net terms. We could be like 115 and 30, which means if I pay it in one day, if I pay it in 15 days, I get 1% off. Otherwise, I have to pay the whole thing in 30 days. So that's kind of like what trade credit's about. The line of credit. So line of credit is a specific amount of money that we can get from a bank. Could be, let's say, $10,000. And that's the only amount of money we can do. And once we pay it off, that money's done. That money's gone. We can't use it anymore. That leads us to the revolving credit. So let's go with that $10,000 again. In the line of credit, 10,000 is 10,000. But in revolving credit, we can pay up to 10,000. We can get to $10,000. When we pay our debt down to 8,000, we still have now an available $2,000 available. That revolving credit. So what we pay, we can reuse in terms of credit. And so, in a personal standpoint, you might see this in a home equity loan, but you also see this in business as well. A couple things here. We talked about long-term debts earlier. In terms of debt, where we get it from issuing bonds. We can also borrow from banks. We talked about that with revolving credit in the last slide. And then investments from selling new stock and reinvesting earnings. Now, here's the thing, and companies run into this issue. So let's say, for example, you have a whole bunch of stockholders and you're ready to turn a dividend. A dividend is amount of money given to a stockholder that's kind of like a profit, you're sharing profits. Well, some of these stockholders say, hey, wait a minute, put it in back into the business and reinvest. Other stockholders are going to say, hey, we want our money. We invest in you, we deserve a dividend. So that's something that they have to balance. Now, in terms of corporate bonds, Corporate bonds, like you see in the slide, is basically an IOU. You come in and you buy $1,000 bond from me. What I have to tell you is that you give me $1,000 in 10 years, I'm going to pay you $1,200 for that bond, $200 interest over the 10 years. I know, not a lot of interest, but bonds typically are safe because they have that rate of return, but it takes a long time to get that rate of return. However, if the business goes under, then you lose the money for the bond, just the same as you would for the stocks. Okay. So that's something about the bonds. So the bonds do take a long time, but again, you can get a return on these. So debt financing is just basically where we take money out of a bank and we issue, you know, we sell bonds, we sell stock, we are debt financing. Risky, but we get money, so we're trying to invest. Equity financing is that, we're selling stock. We're trying to get stock from, we're trying to get people to invest in us. We're doing a marketing campaign saying, hey, invest in our organizations is what we think we can do. So let's talk about some pros and cons of debt financing. You got interest payments that are tax deductible, and that's a good thing. That's a good thing. We can write off some of the interest on that, and it encourages people to borrow money to pay for their business. You look on the flip side of that, you're going to have to make some payments. All right. And these payments have to be fixed. You have to set a budget. So what happens if you do not get the money to make the fixed payment? So that could be a challenge. Equity financing. Equity financing, no payments required. That's good. It's good, so, but on the flip side, you see that, we don't have the same tax benefits as we did from borrowing. So there's pros and cons, and I can't tell you which one to use because it's all a personal preference. So what I want to do here is just introduce you to all these different types of topics. And then if you ever to run a business, be an entrepreneur, run your own business or franchise, whatever the case may be, you could look at these ways of financing your organization. And it's not one size fits all. It just depends what you're looking at and what you're comfortable with. All right. So in regards to leverage, be careful here. There's something to say you be over leverage. That means you have too much debt. And so you're using the debt to basically try to grow the business. But be careful with this. Um, if we have lean times, and you can see in the second point here about reducing the financial return, if times are lean, you're not going to have a lot of stockholder return, and stockholders may pull. And if they pull their money from you, you're even in more dire straits in terms of money, in terms of financing your organization. So be careful here. You may want to have almost like a rainy day fund, for lack of a better term, to try to salvage any type of relationship with your stockholders if they become unhappy with you. Okay. I'm not going to go too much into these sheets. You can see this in your book. But what this does, it just allows you to see in a very short snapshot what is going on with the organization. So taxable income, if it's strong sales, it's going to be 160,000. Weak sales, we know it's going to be 80,000. It's a projection. And like I said, I'm not going to go over this with you too much. Again, you read the book. So the ROE, return on equity, 12.8% strong sales, that's great. 6.8% weak sales. Your stockholder is going to say, hey, what's going on? Okay. The Dodd-Frank Act, that's where I was telling you the CEOs have to say what's going on with their financial statements and it's accurate. That's because of Dodd-Frank Act. And this really came about with Enron, where Enron kind of misled their shareholders and their employees. And so now what the CEO has to do is they have to sign off on their annual report and that all the financial statements in there are accurate and true. Otherwise, they will go to jail. They are responsible for it. They sign off on it. And so since we've had that, there's been very, very few instances. As a matter of fact, I can't think of any where there's been any type of fraud due to a CEO or an organization trying to manipulate their books to try to fool their stockholders. Okay. So US Treasury bills. These are these are bills that you can these are bonds that you can buy from the US government. Now, a couple things about these. I don't know how familiar you are with Treasury bills. I just want to give you a brief overview. So if you want to buy, let's say, $100 bond, typically Treasury bills will mature in 30 years. So you buy a $100 bond, you pay $50 for it. And over the course of that 30 years, it grows at $50 interest. You can cash in that bond at any time you want. You are guaranteed to make that $100, the $50. So your $50 bond you buy now, in 30 years, will be worth $100. You're not going to get rich off of bonds of US Treasuries. However, they are a safe investment. Now, there's some that will also be in like 10, 15 years where they mature, and you can look at those. I've known of some people that just bought bond after bond after bond, and they paid for a lot of education that way. But again, it's patience, it's time, but you will make money off of it. So US Treasuries are a safe investment, but it takes time and you have to have patience. Right. So in accounts receivable, and it's very similar to the trade credit that we talked about. Pay me now, pay me later. You can pay your bill now, or you can pay it later. I've worked in instances where uh, we get 15 days to pay, we get 1% off, or maybe 2% off the bill. And what that does, it entices the customer to want to pay their invoice quicker so that the organization has money. And remember, we talked about this earlier. Cash is the lifeblood of the organization. So the sooner they can get their money from their customers, the more cash they have on hand. All right. So in regards to capital budgeting, you see here on the slide here about the long-term investment proposals. We're taking a look at how we can spread out payments to buy these large pieces of equipment. And you look at this in terms of benefits and costs of long-term investment. We gotta have like a crystal ball here and say, is this investment really good for us? Is this something we want to do? Is it just a trend right now? Is it something with foreseeable future that people are going to want? And so there's a little bit of risk in that, but if you're right, it's going to go well. If you're wrong, yeah, it's not going to go so well. All right, time value of money. Simply put, is we take a look at if we have a present value of money, the future value of money. So present value of money is what an organization's cash is worth based upon the money for investment. So let me explain it to you. Let's say, for example, you want to have $15,000 10 years from now, and you have 7% interest compounded quarterly, and you want to know how much money you need to invest now to get that $10,000. And so you do the calculations. There's a whole table and calculation you can do. So for the $10,000, you may need $5,000 now at 7% interest compounded quarterly to hit your target. That's what the present value of money is. How much money you need now to achieve a specific goal in the future. Now, we're going to end on this. The net present value is how much the investments and cash flow that we get minus the initial investment. Okay, so let's say, for example, we invested $1, and then we end up making $1.25. All right, so we had cash flows $1.25, and we had the initial investment of $1. Our net present value would be 25 cents. Okay, very simplistic example, but you get the idea. So the net present value is a very good way of seeing how much your investment is actually coming through. So that is our discussion about chapter 9. I hope you enjoyed it, and I know it's a little choppy at times, and I apologize for that. If you have any questions, as always, please let me know. Take care of yourselves, and I will see you in the next chapters.